Welcome back to Stock School Daily.
Who's sitting at number 12 and number 13?
Mm-hmm.
Strive, this relatively small, kind of obscure asset manager slash medical hybrid, now has a larger Bitcoin treasury than Tesla. They have more corn than Elon Musk's car company, more than Trump media.
It creates this fascinating cognitive dissonance, doesn't it?
Hmm.
Because you think of Tesla and you think of, a trillion-dollar story. You think gigafactories and global dominance.
Right.
And then you look at Strive. Their market cap is hovering around, what, $921 million? They haven't even cracked $1 billion yet.
That's the wildest part. You have a sub-billion-dollar company holding more of the hardest asset on Earth than companies even 100 times their size. It's like finding a Toyota Corolla that has a jet engine strapped to the roof.
That is a terrifying image, but
Yeah.
it's accurate. And the market is reacting exactly how you'd expect when it sees a jet engine on a Corolla.
With total confusion.
Total confusion.
Ah.
The stock is trading like a penny stock, bouncing between 97 cents and maybe $1.05. It's just incredibly volatile because no one quite knows how to value this thing yet.
Well, that's what we need to figure out today.
Strive bought Semler because they needed the engine inside the car.
The cash flow engine.
Exactly. Semler wasn't a crypto company. They were, and still are, a medical device company. Their flagship product is called QuantaFlo.
Which I have to say sounds like something from a sci-fi movie, but it's actually incredibly grounded. It's for testing vascular disease, is that right?
Peripheral arterial disease, yeah. It's a diagnostic tool you'd find in clinics and doctors' offices. And here's the thing about medical devices like this. Once they are approved and adopted, the margins can be spectacular.
It's not flashy.
Not at all. It's not Web3. It doesn't have a community on Discord hyping it up. It just prints money.
And that's the cheat code everyone is talking about.
Right. Think about the risk profile of a standard Bitcoin holding company. If you're leveraged to the hilt borrowing money to buy Bitcoin, what happens if Bitcoin goes sideways for 3 years or drops 40%?
You've still got interest payments, debt covenants.
It gets sweaty. But if you own a medical business,
Yeah.
well, people don't stop getting vascular disease just because the price of Bitcoin dropped.
The demand is stable.
QuantaFlo keeps generating operating profit, cold, hard cash. And the new chief strategy officer, Avik Roy, has a very clear mandate. Take that operating profit, not borrowed money, but earned money, and funnel it directly into the Bitcoin treasury.
So it's a volatility buffer. The medical side stabilizes the ship while the Bitcoin side just captures all the upside.
Precisely. It's non-dilutive accumulation. They don't have to water down your shares to buy more Bitcoin. They just have to sell more vascular tests.
Yeah.
It's a much, much more sustainable model for long-term holding than pure leverage.
Okay, I want to push back on this for a second, though, because we've seen this movie before in corporate America.
Oh, sure.
A company's core business starts to plateau or they get bored and they pivot to the current thing just to juice the stock price. Remember when everyone was adding blockchain to their name back in 2017?
I do.
How do we know this isn't just a desperate attempt to make a boring medical stock exciting?
That is the skepticism you should always have. And frankly, it's why the stock is at $1 and not $10. The market is asking that exact question. Is this for real?
So what's the answer?
Well, there are two things that suggest this isn't just a pivot for clout. One is the personnel, which we should get to, but the other is the math. QuantaFlo is a high-margin product with a very low cost of overhead. It's the ideal cash cow to pair with a volatile asset.
It's not a failing business trying to hide.
So it's a profitable business being repurposed.
Repurposed into a Bitcoin vacuum cleaner.
Essentially, yes.
Okay, so that's the fundamental value proposition. You buy the stock, you get a piece of the Bitcoin, and you get a medical business that buys more Bitcoin for you automatically. But there's a technical side to this trade that's looking pretty spicy. I was looking at the short interest data.
Yeah, the squeeze setup.
The data says short interest is hovering near 30%. Now, I know 30% is high, but for a listener who maybe just buys index funds, can you put that number into context? How dangerous is that?
It's exceptionally high. To put it in perspective, for most large, stable companies, short interest might be 1 or 2%. If it gets to 5%, people start asking questions.
Okay.
When you see 30%, it means nearly 1 out of every 3 tradable shares has been sold short. People are betting heavily that this stock is going to zero or at least dropping significantly.
That feels incredibly risky given what we just talked about. I mean, if they hold over 12,000 Bitcoin and Bitcoin rips to, say, 150K or 200K, the value of the company has to go up, right?
You would think so. And that's why I call this the pain trade. Shorting a company that holds a volatile, explosive asset like Bitcoin is like playing with matches inside a dynamite factory. All it takes is one spark.
And the spark would be the price of Bitcoin moving up.
Bitcoin moving up, or a good earnings report, or even just a change in sentiment. If the stock price starts to rise, those short sellers are underwater. They have to buy the stock back to close their position and stop the bleeding.
Which drives the price up even further.
Exactly. It's a feedback loop. And here's where the Strive shareholder base makes it even more explosive. Who do you think owns this stock? It's not day traders looking for a 5% gain.
It's Bitcoiners.
It's the laser eyes crowd, the HO dealers.
Right.
And their psychology is just different. They don't sell. If the price doubles, they don't cash out. They tweet, "Have fun staying poor," and hold on even harder.
So there's no supply.
There's no supply. So if the shorts need to buy shares to cover, and the existing shareholders just refuse to sell, the price can create a vacuum straight upwards.
A violent move to the upside is the phrase I saw.
That's market speak for. A lot of short sellers are about to lose their shirts very, very quickly.
So putting the squeeze dynamics aside, what is the stock actually worth? Because right now you can pick it up for about $1. That seems cheap.
Valuation is tricky here because you have to value both the business and the Treasury. The institutional analysts, the suits at Maxim Group, they have a buy rating on it with a target of $1.50.
So a 50% upside from here, that's a solid win in anyone's book.
It's very healthy, but that's a conservative fundamental valuation based on the current numbers. If you look at social sentiment, the retail investors, the people actually driving the volume, they're targeting breakout levels of $3 or even higher.
Wow.
They're pricing in future accumulation and a potential Bitcoin bull run.
So the floor is the medical business, but the ceiling is basically wherever Bitcoin decides to go.
That's the bet.
I want to circle back to something you mentioned earlier, the personnel. Because you can have the best strategy in the world, but if the people running it are incompetent, it just doesn't matter.
Sure.
And frankly, usually when you see a merger of equals like this, you end up with a bloated board of directors who can't agree on anything.
Yeah, it is a huge risk. But in this case, the sources are calling the leadership a dream team. And it's not because they're famous celebrity CEOs. It's because they're philosophically aligned with the mission.
Let's talk about Joe Burnett. He's the new VP of Bitcoin strategy. I've seen him on X for years. The guy lives and breathes this stuff.
He does. He comes from Third Capital. And his role at Strive isn't just some fancy title. He has a singular metric for success.
Which is?
Bitcoin per share.
I feel like we need to double click on that. Why per share? Why not just total Bitcoin?
Because total Bitcoin is a vanity metric.
Yeah.
I could go out and issue 1 billion new shares of stock, raise a ton of money, and buy 50,000 Bitcoin. But I would have diluted you, the shareholder, into nothing. Your slice of the pie would be microscopic.
So I'd own stock in a company with a lot of Bitcoin, but my specific share would represent dust.
Exactly. Bitcoin per share is the discipline. It means Burnett's job is to make sure that every deal they do, every dollar they spend, actually increases the amount of Bitcoin backing your specific share. It forces them to be efficient. It prevents them from growing just for growth's sake.
It's accretive value.
It's the only metric that matters for a holding company.
If you found this helpful, hit that like button and subscribe for more.